Hello viewers, I know it's difficult to find good quality stocks at the moment. It's a bit of a minefield out there. Well, I've got an undervalued UK dividend stock for you with a dividend yield around about 5%. Let's have a look and see if it could be a stock to buy. Stock we're reviewing is a bank, and a good solid way to review banks is via their book value. So we can compare their price to their book value. If the book value is above their market price, then there's potentially a sign of an undervalued company. For this company, first of all, the price trades currently at £3.70 per share on the stock market. In the last year, they've had a really good run up from around about just over £2 all the way up to over £4.50, but they have dropped off to £3.70, so this provides a potential buying opportunity. Just before we get into that detail, please remember this isn't financial advice or investment advice in that I don't know your personal circumstances and you'll have different risk tolerance and preferences and portfolio to me. So do your own research. Do take this as education entertainment only. So for this company, we've seen they've had a drop off. They're at £3.70 in the market, but the book value per share is at £5.18. So this suggests there's actually quite a disconnect there. There could be a bit of value, particularly following the recent price drop off. I'll just have a look at a second source here on Simply Wall Street, and that confirms, if we have a look at the data, that the book value figure is £5.18. So we'll go with that. Interestingly, Morningstar has £6.85, which is a much higher book value, but given we've got two sources with the £5.18 figure, I'm going to go with that. Always take the more conservative view when making your calculations. That means the price to book ratio is about 0.77. So that suggests a good level of potential value based on the current market share price. And this company is Investec. Now looking at Morningstar, we can see that this company generally is double figure margin company, generally quite above 10%. The return on equity is generally in double figures as well. Now, with the financial health of the company, we had a debt to equity ratio of 1 back in 2019. That has dropped down to 0.71. You can see here that there is still a decent amount of debt on the balance sheet, but there is more cash and short-term investments than the debt. They're probably not at short-term risk of failure. And the other thing is we have a look at their profitability, and with their profitability, we can see that it's normally in the double figures percentage-wise and generally quite above 10%. And the return on equity generally is double figures as well. So what we've got here is a profitable company that potentially is undervalued based on book value. But I'm going to have a look at two more things here. We're going to look at the dividend, and then we're going to have a look at the P/E ratio. So Simply Wall Street has got the dividend figure at just over 5%. Yahoo has it bang on 5%. You'll quite often find small differences between these sites, so it's good to look at a couple just to get a view of the figure. If we go with 5%, so with 2021, we're going to have a look at their dividend for that year. And according to the website, the London listing, we've got 7.5, 5.5p, so that's a 13p 2021 dividend. And that's also the information that is here on the Morningstar site. However, going forward, it looks like the dividend is going to go up. You can see that the interim dividend of 11p is much larger than the 5.5p of the year before, and they have a payout ratio target of 30 to 50%. So based on the most recent figures, we've got that payout ratio at the top end of that, 48%, and then the yield of just over 5%. That's a very strong dividend. I'm just going to have a look at the P/E ratio. So the P/E ratio at the moment is around about 10. So Yahoo's got 10, and Simply Wall Street's got 10. Simply Wall Street's got a PEG ratio of below 1, actually 0.5, which means it's going to grow at a higher percentage number according to their analyst expectations than the P ratio. So that's the Peter Lynch number, it's sometimes called. So that is a very good sign. If we have a look at earnings for 2024, where they're forecast to be, we look at 657 million, according to the analyst coverage here, although it's quite low analyst coverage. If you compare 657 million to 2.89 billion, that is around about 4 times larger, perhaps 4.5 times. So you're looking at a forward PE of potentially 5 or less, which looks pretty cheap. Now that is showing a 20% earnings growth on Simply Wall Street. That could be quite optimistic. The Yahoo analysts are showing 11.3% per year over the next 5 years, which perhaps sounds a bit more realistic. So I've gone to buffettsbooks.com. They've got a quite nice calculator for book value. So if we take last year's dividend of 0.13 and the book value of 5.18, let's just say it's going to go up 5% a year, really conservative. And with a discount rate of 11%, you actually get an intrinsic value of £4.40. With a discount rate of 15%, you get an intrinsic value of £3.70. So what this calculator is saying is they pay the dividend of last year, and we know it's actually going to be bigger than that. you take the current book value and it just grows at 5% a year for the next 5 years, and you want discount rate of 15%, so that's doubling the stock in 5 years. Intrinsic value is 372. Market price is 371. So this suggests that according to that calculator, we are priced for a doubling of the stock price in the next 5 years. That's the indicative calculation there. But so do your own research and calculations. That's just my view and how I've assessed it. So we've got dividend of going forward of about 5%, roughly in line with their payout ratio limits. So that should stay roughly stable. We've got PE, forward PE potentially of maybe even 5. We've got another calculator saying that this is priced about right for doubling in the next 5 years. We've got good margins in return on equity for a bank. Now, Simply Wall Street has got a fair value of £4.8, so it's only slightly undervalued. That's actually surprised based on a discount rate of 13%. So it's not too far out from the calculation of the other side. So there's lots of evidence here to suggest that this is still an undervalued company with a good dividend. So if you're looking for something in these difficult times to have some income trickling in that's still got some growth potential, that's a relatively sort of established company, then this could be the one for you. It's really difficult to double your money. Really important to be able to find good quality stocks to do that. So if you click on screen now, here are 5 that I think could double in the next 5 years.